The last time we did capping. And today we are going to do derivatives. When we talk of derivatives, we are talking of when we talk the derivative, we are talking of assets who derive their price from their underlying assets. They derive their price, or their price is determined by an underlying asset. Okay. And examples we have here is futures, forward, option, swap, and futures. I've written futures twice. There is light out here, so. Okay, and swaps. So these are derivatives. They are normally contracts to execute to sell an asset or execute a transaction in future, and it's being influenced by an underlying asset. Okay, so the price is being determined by an underlying asset. Now let's talk about futures. When we talk of futures, please, when you come in, this thing, I don't know why I'm still, I see, when you come in, the first thing you do, you mute yourself. Okay, so futures. When you talk of futures, it is a contract where two parties agree to execute a contract in future, and they agreed on the price and the date, the future date they will execute the transaction. So that is futures. And forward contract is same. Forward contract is same. The difference between forward and future contracts, that futures is normally done in an organized stock exchange. It's being regulated and it's being monitored. A physical stock, it has been regulated, being monitored. Therefore, risk of the transaction not being executed is very low. The risk associated with it is very low. The risk associated with it is very low. Then we have forward contract. Forward contracts, I said the same as futures, but they are done over the counter, right? Where people they can just call up from the phone or internet and agree that we are going to execute this contract in future. It's not being monitored by an organized agent. Therefore, there's a tendency that there's high risk that the person might know what execute it. Now we have options. Okay, let me talk of, since we are going to talk more of options today, let me talk of swaps. When I talk of swaps, it's also an agreement to exchange certain cash flows in future. Okay, then we have option. Since we are talking of option, let's move on. Option is the right. An option is the right to execute a transaction in future. And then they agree on the date, they agree on the price. And the term given to the price is called strike or exercise price. Strike or exercise price. Okay, so the price that they will agree on that they're going to execute, they are going to sell, or they are going to execute the contract and the transaction based on is called strike or exercise price. Okay, now option, as the name is an optional. It's not, or you are not obligated. You are not obligated. Okay, so you can decide to go on with it when the time comes or not. We have types of option. We have two main types of option, and we have call option, we have put option. We have call option and we have put option. When we talk call option is the right to purchase, right to buy, right to buy. Okay, so when you agree that, oh, we are going to execute this, I'm going to buy this particular asset in future at an agreed price, okay, then we call it call option. Call option. And logically, a call optioneer is going to execute it when the price or the strike price, the exercise price, is lower than what? The sorry, when the spot price, as in the market price, then spot price. So as at the time the person we are going to execute the transaction, this person is going to purchase. So at the time the person is going to purchase, call option, right? The person will compare the spot price, as in the current price of whatever asset that you want to spot price. When they say, whenever you hear spots, it means, is that the spell spot? It's as if, please, is the spelling correct? My mind is telling me I've made a mistake.
Yes.
So the spot price is the current price, right? The current price. So that's the spot price. So the person will definitely compare the spot price, okay, to the exercise price or the strike price. That is the agreed price, okay? So if you are the one that you went into that agreement and you are going to purchase the asset, this is a for example, option that you can either buy or you can either exercise or not exercise. So you're going to compare it to the strike price, and the strike price is what? The agreed price. When you're making the agreement, the price that you agreed on is called the strike price. Okay. So you're going to compare it, and if you realize that, oh, the strike price is lower than the spot price, that's what you agreed on, is lower than the spot price, then you are likely going to exercise what? The contract. You are likely going to buy the asset. You're going to, if it's call option, right? Well, put option is right to sell, right to sell, right to sell. Okay. This person is going to compare the strike price to the spot price, right? It's going to compare the strike price to the spot price. And this person is selling, okay? So if the person realize that the strike price is lower than the what? Spot price, then it's likely not to exercise, okay? All other things being held constant, if you are in the market, you have the option to exercise a contract, and you realize that the price that you agreed on is far lower than the spot price, the market price, as at the time the contract is being executed, you are likely not to sell. Okay, so that is it. So okay, take notes. We have two types of option: call option, put option. Call is for right to purchase, right to buy. Put is right to sell. Okay, right to sell. All right. So monies of option. We want to look at monies of option. Right. Now, whenever we talk of monies of option, we just want to know, are we making profit or we are making loss? Okay. Are we making profit or we are making loss or we are breaking even? All right. So now let's see. We have in the monies. In the monies. In the money, to a layman, I would say when the option is making what? Profit. When the option is making profit. So if it's a call option, all right, then the person is buying. Okay, the person is buying at what? The strike price, the agreed price. Okay, now if the person purchases and it happens that the strike price is lower than the spot price, then the person has made what? Again, then the person is coming what? Again, let me represent a gain by gain. Okay, and as it's making a gain, we call it in the monies. Okay, in the monies. The same way, the put option in the monies, we say the person, that particular contract or that particular option, if the strike price is higher than the spot price, that is if it's put option, if it's put option, okay, put option, then he is normally the strike price, they call exercise when they represented by this X, okay? So this X represents what strike or exercise price. If the strike price, that bid price is more than the spot price, representing the spot price by what X, then the call option is making what? Again, then we call it in the what? In the monies. So in the monies to the call option, the person, if the spot price is lower, is higher than the strike price, then in the money, then he has made a gain, then he's in the monies, right? Then put option is when the exercise price is what? Higher than what? The spot price. But he is selling. So if the exercise price is higher than the market price, then he's making a gain. Okay? The person is making a gain. Okay? Now let's go to out of the money. Out of the money is opposite of in the monies. So to a call option, it means the person is making what? A loss. All right. A person is making a loss. Okay. So the call option, option now, who is the call option, who is who purchase, if it happened that the strike price or the exercise price is higher than what? The spot price, means the person is going to pay more than the market price as at then he's making a loss. Then we call it out of the monies. However, if in the put price, in the put option, then if the spot price is more than the strike, it means that the person is making what? A loss. All right, because he's selling at this price, which is lower than what? The market price as at then. Okay. Then when you talk of at the monies, we can use break even to remember it easily, to remember them easily, or to remember it easily. You can look at that break even when the spot price is the same as the strike price, the exercise price. Okay, then we say at the monies. Okay, so for you to remember them easily, when any of them is making a gain at the time of the contract being executed, when it's in the money. If any of them is making a loss at the time the contract is being executed, then it's out of the money. Then if any of them is breaking even, then it's at the money. Okay. All right. Now let's talk about American versus European option. American versus European option. Okay. Now, the difference between American option and European option is that American option is more flexible. right? American option can be exercised before the agreed date, the future agreed date, or on the future agreed date. I repeat, the American option can be exercised before and on the agreed date, okay? But the European option is only exercised when the contract is matured on the future date that they agreed, right? Then that is when it can be exercised, right? So for you to maybe remember it easy, say American is more flexible, like option is more flexible than European option, right? Okay. We want to continue. Another thing we want to know is rare versus financial option. Rare versus financial option. When you talk of rare option, we are talking of exercising a business transaction. When a management or a firm want to exercise business transaction, like if they want to venture into maybe what's the name of this thing? What's the name of this? Capital. Oh, seriously, I've forgotten this thing. Capital, I've forgotten, but I don't know why I've forgotten. When they want to go into it, I know this long-term investment. I don't know why I've got the assessing long-term investment. Capital structure. Capital structure. Capital structure. Okay, so rare option is when the person want to invest into a business. Want to invest into a business. So this one we have various options and the rare option. Rare option is rare. It's hardly done. So it's hardly done. So normally we don't discuss. Normally when we are talking of option, we are looking at financial option. We normally when we are explaining, we look at financial option. But we have rare option. The way we have rare asset, that is more tangible investment that have direct impact on the economy. The rare option is a firm entering into an investment, okay, directly, okay. So examples, we have option to expand. Option to what? Expand. So when you talk of option to expand, maybe a firm want to start a new business in addition to what he's doing, or a firm want to go into expansion, okay, like they are there, they want to maybe add up a new product, they want to set up a subsidiary, okay, set up a subsidiary is an example of option to expand, okay. Any investment that's going to expand the business, that's going to bring add additional work to the firm, then we call it option to expand. We have option to contract. Normally, maybe after studying the market, you realize that this business, it's likely not to go on well, or probably it's not fetching what's supposed to fetch. So you want to divert portion of the money to something else. You can contract, you can reduce the amount you've invested into that particular in that particular asset, or that particular investment that you can reduce it by taking out part of the capital, taking out a portion of the capital or something. Then we have option to abandon. So maybe you did your study and realize that this business venture is not going to profit you, it's not going to do add up, or in future it's going to rather bring loss. It's going to bring loss. You can abandon then you stop operating that business, you stop doing anything with that business, you end it, okay. So that is option to abandon. Then option to delay. Option to delay, that is you, after doing your investigation, you realize that going into the investment now would be less profitable compared to going into it in future, okay. So you delay, you wait till the future time, then you go into it. Then option to redeploy. That is when you either end a particular investment, then you use the same, that's whatever cash flow you got from it to invest into a different business or a different asset altogether. Then we call it option to redeploy. Option to redeploy. Okay. Please, any question? We have financial option. Right? We have financial option. When we talk of financial option, we are talking of yes.
Yeah, please, I want to know if like the nose is there. So
Who is asking?
this Amadou.
Amadou, are you with us? Is this your first time of joining the class? Amadou, is this your first time of joining this class?
No.
Then
So with the kind of question you're asking, I believe this is your first time joining the class.
No. No, I'm trying to find out if how you're explaining them. No, maybe we can get that news.
Amadou, don't worry, I will forward it to you.
So he doesn't even have the lecture notes. Amadou doesn't come for lectures.
I never miss a lecture, so.
Financial option. Financial option, they are assets, they are contracts, or they are derivatives whose price is influenced by a financial instrument. Whose price is influenced by a financial instrument. Its underlying price is influenced by a financial instrument. Okay, so the example is stock, bond, and interest rate. Stock, bond, and interest rate. Okay, all right. Then we have delta of option. Delta of option. No, we said that derivatives, which option is part, their price is being influenced by an underlying asset. Okay, now option delta of option is saying that it's looking at how change in the price of that underlying price, that underlying asset, influences the option price. Okay, so if you are saying that the price of a derivative or an option is influenced by its underlying price, then it means that if there is a change in the underlying assets, that's they base as that asset they base on to determine the price. Okay, let me give something practical. So I want to sell shares to you. Okay, I want to sell shares to you in future date, maybe 1 month or 2 months from now. Now, when we are agreeing on the price, it will definitely be influenced by the current share price. Okay, so that contract we are going into the price that we will determine or we agree on will be influenced by the price of the shares, the current price of the share. We are going to execute this contract in future, but definitely when we are making that, we will base on it from the current price of the shares. Okay, the same way if let's say it's dollars, right? It's foreign currency. Let's say dollars, right? Dollars. If I want to go into contract with you, so probably I'm going to sell goods to you in future. Okay, it's going to be paid in dollars, or probably import the goods in dollars. Okay, now I want to agree on the price I'm going to pay you in that future date I want to execute the contract. Okay, we definitely look at the current dollar rate. The current dollar rate, dollars rate or dollar. Let me go to the dollar rate, right? We look at the current price, the current rate of dollars. So now I think 16 cedis is to $1, right? 16 cedis is to what? $1. So we base on that to make that agreement that, okay, so let's make it 17th because it's likely to go up, because the Ghana cedi is likely to what, depreciate or devalue. So let's make it 17, $1 to 17. Okay, so the contract, that contract is being influenced by what? That asset. Okay, all right, so I think this should be clear. All right, so delta of option is saying that a change in option price is due to change in what? The underlying asset price. Okay, so if they give you data of 0.04, then probably are saying that if there is 1 cedi increase, if there's a, please don't mind my handwriting, okay? There's Ghana cedis. Hey, this Ghana cedi here. So this is Ghana cedi. So 1 cedi increase in the underlying asset will probably result in what? 4 cedi increase in the option price. Okay, so so this is the underlying asset, the increase and how it's affecting the option price. Okay, so that is it. So we are done with the theory, and these are some of the relevant formulas we'll be using. Okay, these are some of the relevant formulas we'll be using. So this is the formula for call option. Now, how do you know this formula for call option? We say call option is for what? Purchasing, buying, and a call optioneer who want to what? Gain profit. Okay, so always is anticipating that the spot price as at that time, okay, the market price, the share price or whatever thing price, that spot price at that time is, the person is estimating that it should be higher than the exercise price, so that you make what? Profit. That's how come spot price is starting and exercise price, that agreed price is, we are subtracting it from it. Okay, so that is the expectation of the okay, so that is it. Now I want us to understand this X here is the spot price, the market price as at there. If it's share, they will say share price. If it's any other security, security price. Is that what I'm talking? The E here is the Euler number, and that number is 2.718. The name there, I don't know, I stand to be corrected. The Euler rule is a number. Okay. The ND1 here is what is here. We'll calculate this to get it. Okay. The X here represent the exercise price, the agreed price, the strike price. Okay. So that is it. I've already explained it. Let's D is dividend rate. Okay. C is the period, time. R is the rate of return. D2, we are going to calculate this to get it. Okay. And looking at the formula, we have to calculate D1 before we can get D2. Okay. Okay. I think what is new here? Standard deviation is here. You know, you've seen the standard deviation here. Okay. That's a sign of standard deviation. That is the put option. So put option is what? Right to sell. And the person who is selling is hoping that the agreed price will be what? Higher than the what? Spot price. So that profit, profit will be made. Okay, so you see that normally start with exercise price and spot price. Okay, so sometimes I will not be having a formula in my head. I try very much to understand the formula so that when I see it, something unique about the formula, so that when I see it, I'll know that this is for this and this is for that. Okay, all right. So let's move on to calculation. Any question? Any question? Any question?